Okay, let's dive into this. Welcome to today's explainer, where we're going to completely rethink how you handle your idle cash. Look, we all work incredibly hard for our money, right? But honestly, far too often once we earn it, we just let it sit there, doing absolutely nothing. Today, we're unpacking exactly why savvy savers are moving their cash around and choosing overnight funds to make their sleeping money work for them. We're going to look at the numbers, the logic, and honestly, just a much smarter way to manage your cash reserves.
So let's start by looking right at the core of the issue here. Is keeping your money, your hard-earned cash, in a standard savings account actually the right move? I mean, we've all been conditioned to just park our cash in the bank, right? Because, well, it feels safe, it's highly accessible, but when you really look at what that cash is doing for you day in and day out, it's basically taking a long nap. You're giving up potential gross just for the comfort of familiarity. So I think it's time to ask ourselves if that traditional banking habit is actually costing us money.
And man, here is exactly why that habit is so painful. When you leave your money in a traditional savings account, you're typically looking at a meager 2 to 3% return. 2 to 3%. That is incredibly low. But wait, it actually gets worse. Because from these tiny microscopic earnings, the bank goes ahead and deducts TDS, tax deducted at source. So think about it. Your money is barely growing at all, and a chunk of that tiny growth is literally being sliced off automatically before you even see it. It's a totally frustrating reality for anyone just trying to build their savings.
But don't worry, there's a brilliant upgrade for your sleeping money. Let's move into Section 1. What are overnight funds? The smart alternative for idle cash.
Instead of letting the bank dictate those tiny returns, overnight mutual funds offer a highly structured, highly liquid environment where your money is put to work, quite literally, overnight. In fact, overnight mutual funds are currently seeing annual returns of 6 to 7%. Let that sink in. You are essentially doubling or even tripling the efficiency of your cash compared to that old 2 to 3% savings account rate. By simply shifting your money from a standard bank account into an overnight mutual fund, you unlock a completely different tier of passive earning for your idle funds. And the benefits don't even stop at the interest rate. With overnight funds, there is absolutely zero TDS deducted. Now, just to be perfectly clear, you do still have to pay standard income tax on your earnings later on, based on your tax bracket. But your money isn't being held back by automatic source deductions right out of the gate. Plus, you get a 0% entry load and a 0% exit load. You're not paying a penalty to put your money in, and you're certainly not paying a fee to take it out. It is just pure, frictionless efficiency. Now, knowing this is really only half the battle, so let's look at Section 2, 3 investment options and finding the best route. If you look out into the market today, there are roughly 44 different overnight mutual funds currently available. With dozens of options out there, we're going to break down the 3 primary pathways you can take to invest in these funds. First, you could use your standard DMAT account. Second, you could go directly to an asset management company or AMC. Or third, you can utilize Smallcase mutual fund baskets. Keep these 3 in mind because we're going to put them head-to-head right now to see which one actually gives you the liquidity you need. And this brilliantly illustrates the differences, specifically when it comes to getting your money back. Take a look at the DMAT account row. A lot of people think you get instant withdrawals here, but you actually get 0 rupees in instant withdrawal limit. Everything takes T+1, meaning the next business day. So, if you requested on a Friday, you might be waiting until Monday. That completely fails the instant liquidity test. Now look at Direct AMC. This solves the problem partially by giving you a 50,000 rupee instant withdrawal limit, but the rest is still T+1. Finally, look at that bottom row, Smallcase baskets. This scales the solution perfectly, bumping your instant withdrawal limit all the way up to 1.5 lakhs. That massive jump in liquidity brings us to Section 3, the 5 benefits of Smallcase baskets, the ultimate liquidity hack. Here's exactly how this setup works in your favor. First off, a Smallcase basket bundles multiple mutual funds together, say 3 different overnight funds. Because each individual fund gives you a 50,000 instant limit, bundling 3 of them triples your total instant limit to 1.5 lakhs. Just remember, to access that instant cash, you do have to request the redemption directly on the individual AMC websites. Second, you don't have to guess which of the 44 funds are actually good. These baskets are curated by SEBI-registered research analysts who look at fund age, managers, and expense ratios for you. Third, the basket auto-rebalances. If a fund starts performing poorly or a manager leaves, it's automatically swapped out for a better one without you lifting a single finger. Fourth, right now, using these mutual fund platforms is entirely free. Literally 0 additional platform or subscription fees, you just pay the standard fund expense ratio. And finally, instead of managing multiple chaotic folios across different sites, you get one clean, single tracking dashboard to monitor your cash. The whole shebang in one place. Now, what's really interesting about this slide is how it compares to other options you might be wondering about. Let's look at section 4, overnight versus liquid funds, and figure out which one is actually for you.
All right, here is your screenshot-worthy rule of thumb. On the left, we have overnight funds. These invest exactly as the name implies, at the overnight rate. They're relatively safer and, honestly, absolutely perfect if your time horizon is just a few days or maybe a couple of weeks. On the right, we have liquid funds. Now, these invest in debt securities with maturities of up to 90 days. Because the duration is a bit longer, they might offer a slightly higher return. So, the golden rule is this. If you think you might need the cash in a few days or weeks, prioritize the safety of overnight funds. If you know for sure you won't touch the money for 3 to 6 months, liquid funds might be the better play to capture that slightly better return. And the best part? Both of these options are available as baskets on the Smallcase platform.
Which brings us to our final and arguably most important question. Is your money currently sleeping in the bank? We've seen the data. We've seen how that 2 to 3% return just gets eaten alive by TDS. And we've seen how easy it is to leverage expertly curated baskets of overnight funds to hit 6 to 7% returns with massive instant liquidity, zero exit loads, and zero entry loads. The tools are literally all laid out right in front of you. The only question left is whether you're going to let your cash keep snoozing, or if you're finally going to put it to work. Thanks for joining me on this explainer, and I highly encourage you to start looking at your idle cash a little differently today.